What does the future look like for interest rates, and how will it affect the housing market? As many of you know, interest rates are a key driver in not only the housing market, but the economy as a whole. And over the last 18 months or so, we've seen interest rates stay artificially low because the Fed has been buying nearly $80 billion per month in treasuries and $40 billion in mortgage-backed securities. And a lot of people believe that as the Fed starts to taper their purchases, you're going to see a rise in interest rates. And that's what we're going to discuss in today's video. We're going to talk about what the future looks like for interest rates over the short term and what it could look like as we move into 2022, how it might actually affect the housing market, and when we should start to see some of these effects take place. In addition, we're also going to show you what it actually looks like with regards to rates changing. You know, over the last week or so, we've seen the 10-year Treasury hit the highest point since about June. And at the moment, it's impacted rates somewhere between 1/8 and 1/4% over the last 7 days. What does that actually mean with regards to your purchase price? What does it mean with regards to your payment? I'm going to help you understand that by showing you a couple of examples of where rates were last week versus where they are now, so that you can see exactly what happens as interest rates move up and how it may affect those of you looking to purchase in the future. Lastly, we're going to talk about when you should actually lock in your rate. If you're out there shopping for a mortgage at the moment, looking to purchase a home, maybe you're in escrow wondering if you should lock, or maybe you're even considering refinancing, when is a good time to pull the trigger on that with all of this potential news out there. That's what we're going to discuss in today's video. But before we do that, I want to take a minute and introduce myself. My name is Jeb Smith. I'm a real estate broker here in Southern California. My channel's all about real estate, helping guide you through that process, helping inform you so that you can make logical, rational decisions in the home buying, home selling process. So do me a favor, if you find any value in this content at all, hit that thumbs up. Feel free to share this with anyone you know that may benefit. So earlier today, Fed Chairman Jerome Powell came out and said that higher inflation is going to run longer than initially anticipated. If you've been following this at all, the Fed has more or less said that the majority of the inflation that we're seeing out there is transitory, and a lot of it is due to supply chain bottlenecks, and that over the next couple of months, that's going to work its way out, and that inflation number is actually going to come down. But the market didn't feel that way today, right? The stock market as a whole, big pullback in stocks, and at the same time we saw the 10-year Treasury go above that 150 threshold, which we haven't seen since last June. Now at the moment it's trading in a range and will likely hit maybe the 160 area and pull back. But if it does pass that 160 area, the next point of resistance is that 1.74% area that was back in March, which means that in the short term, you're likely to see interest rates move sideways to up versus pulling back in the short term. But what does that actually mean? Well, if you're looking to purchase a home, it means that you may see interest rates move up over the next couple of weeks. But at the same time, if we don't break that 160 threshold and we actually hit it and pull back, that becomes a point of resistance, you might see interest rates pull back for the short term. But at the end of the day, what matters is that interest rates are more or less going to trade in a range over the next couple of months. You're not likely to see big, huge increases in rates, but at the same time, you're not likely to see big, huge decreases in rates either. So the question becomes, what happens when the Fed starts to taper their bond buying, right? That seems to be the question on everyone's mind. A lot of YouTubers are out there talking about it, saying, hey, when the Fed decides that they're going to start to taper their bond buying, that is when interest rates are going to start to move up and you're going to see a change in the housing market. Well, I disagree, right? I disagree because the Fed has more or less come out at this point and said that they're going to start tapering bond buying as of November, right? That's when the next Fed meeting is. And, you know, if all signs in the economy are doing well, at that point is when they'll start tapering the bond buying. But keep in mind, a lot of that is already built into the market. The expectation is there, the anticipation is there, if you will, because, you know, they've already kind of laid out this schedule, if you will. So a lot of what's going to happen with regards to the market and interest rates are going to be built in prior to that meeting. But at the end of the day, we do know that a lot of what's happened in the housing market is due to low interest rates. But it also has to do with low supply and high demand. But as interest rates go up, you're likely to see some buyers step off the sidelines, affordability become an issue for other buyers. And if that's the case, you're likely to see inventory build a little bit. which helps balance that supply and demand equation and more or less calms things down in the housing market. Now, I do believe that's going to happen. I just don't believe it's going to happen in the short term. So earlier in the video, I mentioned that rates were up about 1/8 to 1/4% over the last week. What does that actually mean with regards to loan amounts? How much does that affect your payment? Because at the end of the day, that's what matters. Most people buy the payment, not the price of a property, right? They're more concerned with how much they pay per month versus how much they're paying for that home. If I told you you could buy $1 million home for $2,000 a month, you wouldn't be concerned with the price that you're paying for that home. You'd be more concerned with, can you make that $2,000 a month payment? Now, at the end of the day, that's not a realistic number, but the idea here is that you don't really care how much you're spending as long as you can afford that monthly payment. Take a car, for example. When you go in to purchase a car, most people are looking at the monthly payment. They don't care how much the price of that car is. They just care how much do they have to spend every single month on that lease or that payment in order to purchase that car. It's no different with regards to buying a home. So how much does that 1/8 to 1/4% actually impact your purchasing power? Well, that's what we're going to talk about right now. So if you were to purchase a $300,000 home about a week ago, interest rates on a 30-year fix were around 2.875%. Now, a lot of you watching this video are saying, well, I got higher than 2.875. Did I get a bad rate? Or on the other side, I got much lower than 2.875. Did I get a really good rate? I'm just using an average here based on conversations with lenders, looking, at interest rates, that sort of thing. So don't take these numbers and use them for your own personal scenario. I'm merely using them to give you an example of how rates have changed over the last week and what it actually shows. So interest rates last week, again, around 2.875 on a 30-year fixed. A $300,000 purchase price, that payment would be $1,244.68. But we've seen interest rates rise about 1/4% over the last week, which takes that rate on a 30-year fix up to around 3 1/8%. So at 3 1/8%, your payment is $1,285.13. So is that really a big deal? Well, it's a difference of $40.45 per month. Now, for many of you out there, you're going to be like, that's not really a big deal, right? I just cut a couple coffees out. I don't eat lunch during the week, and I've got my $40, and not really that big of a change. And that's what I want to point out to you here is that, rates going up 1/8 or 1/4% doesn't really change things that much. But if you continue to see rates creep up 1/8, 1/4%, not only is it going to affect your monthly payment, it might affect your purchasing ability as well, right? If your debt to income ratio is close to the threshold of the loan you're trying to get, you might be in a position where you can no longer purchase that $700,000 home because your payment has exceeded that threshold. And therefore, you might be now looking at a $650,000 or $675,000 home if interest rates were to go up. But in the short term, I don't really see that happening. I just want to show you what it actually means if you're looking at interest rates right now. So let's do that same example on a $400,000 home. At 2.875%, your payment would have been $1,659.57. But with that 1/4% increase in rates over the last week at 3 1/8, that $400,000 loan is $1,713.50. Now that's a difference of $53.93, almost $54 per month. At the end of the day, not going to be a big deal for the majority of people out there, that 1/4% move in rates. But if we continue to see that, that's where you see the real impact. Now, let's take the same example. At 2.875% on a 30-year fix last week, that payment would have been $2,074.46. But with that increase in 1/4% to 3 1/8, you're looking at a payment of $2,141.88 per month, which is a difference of $67.42. So, that 1/4% raise on a $500,000 purchase price raised your payment by about $67 per month. Again, not really a big deal at the moment for the majority of you out there looking, but you can see how that might affect your ability to purchase as we move forward. So the question is, what's going to happen to interest rates over the next couple of weeks to months as we move closer to 2022? I think you're going to see rates trade in a range. right? I think we've seen the low end of that range for the time being, which is somewhere around that 2.75% or so on a 30-year fixed using a conventional loan. And I think the high side of that range is probably somewhere around 3.25%, right? Today we're trading somewhere around 3.125% on a 30-year fixed. So I think you're going to see rates stay within that range for the foreseeable future. The Fed has more or less laid out their plan. And until something changes on that plan, you're not likely to see them, taper their bond buying. You're not likely to see any change in the Fed funds rate until sometime in 2022, probably late 2022. So the only real change that might affect the housing market is that if employment numbers came out way better than anticipated, you might see, them start to taper sooner. But if you see the opposite happen, if employment for whatever reason just goes through the tank and doesn't improve and actually gets worse, you might see them not even taper in November, which is anticipated. And if that happens, then you could see rates really go low. But what I think you're seeing is rates stay in that range, as I've mentioned before. Now the question becomes, if you're looking to purchase a home or you're looking to refinance, when should you actually pull the trigger on that loan? Should you wait for interest rates to come back down, because we said they're going to be in that range, or should you just lock it? And what I've always said is if the payment makes sense to you, you're comfortable with that payment, you should always lock it versus floating and trying to play that game. Because hindsight is always 20/20. If rates were to go up, you're always going to say, I should have locked it. Now, the opposite is also true. If rates were to go back down, you're going to say that you wish, you would have waited. So what I suggest is if the payment is comfortable to you, it makes sense, it works with your budget, lock in the loan. Don't risk chancing it because, again, a change in that rate isn't going to make that big of a change in your monthly payment. And once you start making that payment, you're going to be less concerned about that rate anyway. And also, another thing is once you lock that rate, stop looking at interest rates, right? Just move on, know that your rate is locked, and continue, with the home buying or refinancing process. And that way you don't have to concern yourself with where rates have gone. Again, focus on that monthly payment. And at the end of the day, as long as you're comfortable with that, then you shouldn't have any concerns. Now, some of you are watching this video going, I'm hearing on the radio that rates are 1.75% or 2%. How can I take advantage of that? You're out here talking about 2.875% on a 30-year fix. Well, do me a favor, check out this video here where I actually talk about people out there advertising these low rates, what it means. Let me know in the comments below what you think. But for now, I appreciate you taking the time to watch. I appreciate the support. Hope to see you again soon. Have a great day. Bye-bye.